Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we dissect the state of the property market. Louis, thanks for joining us as always.
Good to be with you once again, Peter.
Louis, quite an unbelievable first half to 2026. Before we go into the issues that determined the market, as we're at the midpoint of the year, where are we numbers-wise?
Well, it's certainly a national housing downturn now, Peter. It's spread beyond Sydney and Melbourne. The capital city average decline since the start of the year now is looking at about 2.5% to 3%, and Sydney's looking at like about 3.5% to 4%.
If we bring up the issues that have determined the market this year, 3 interest rate hikes, rising inflation, the unemployment's popped, unfortunately. That's obviously hit consumer confidence. The Middle East war that began on February 28, the federal budget no less, on top of all of that, and then unsurprisingly auction clearance rates have fallen. What would you say are the issues that have impacted and hit the market to the degree you've just outlined?
The market has suffered a series of shocks, starting from the interest rate rise in February, then going into the outbreak of the Middle East war at the beginning of March. Then, of course, we had 2 further interest rate rises. Over and above that, energy prices started to rise, and there were real concerns about petrol rationing. And then over and above that, we had the property taxation changes, where we recorded a real lurch down in the clearance rate, which was already weakening following the interest rate rises and these other factors. But just the announcement of the property taxation changes definitely saw an exodus of investors out of the market, and we saw clearance rates on our numbers fall in Sydney from, I think it was about the low 40s, which was pretty weak, down to the low 30s.
So there is some debate as to what impact the budget had on this downturn, given the market was, as you said, falling leading into the budget.
Yes.
What are your numbers showing in terms of the true impact across the country?
There has been a true impact. It would be wrong to say that this is the sole reason for the housing downturn.
Yeah, agreed.
But it's also wrong to suggest that that the property taxation changes have had no material impact. As I note, some ministers have said very recently, or implied that fairly recently. That's disingenuous.
So what you're saying is that those that are out there blaming the entire downturn on the budget are wrong, and those that are on the Labor side of things that are saying the budget's had
got
no
nothing to do with it
are also wrong.
It's a combination of factors. That is what the data is exactly showing. But yeah, the property taxation changes have definitely impacted the market. Labor outlined that they knew this would impact the market at the beginning when they announced this. So we're hoping for more affordable housing. Well, they're getting it.
I think that's a point that needs to be made. Affordable housing is code for falling house prices, isn't it?
Yes, it is.
Yeah.
In an ideal world, what you would prefer to see is a situation where affordability improves by rising incomes compared to housing prices, where you see some nominal growth in housing prices, but family incomes are growing quicker.
Or as a society, we're building more homes at an affordable rate for younger people, but that's not happening because of building costs.
That is correct. Well, it's not happening for a number of reasons, but yes, building costs is definitely a major factor.
Yeah. Now, we could talk about the dire state of the market, but I do want to talk about what's performing best in Sydney. Now, performing best doesn't mean it's necessarily rising, but what areas or segments of the market, in your view, have been most resilient during this downturn in 2026?
Affordable units have appeared to have done a little bit better, and we've noticed this now in more recent cycles. So what we see is that during upturns, freestanding houses outperform units, and during downturns, units outperform freestanding houses.
Yeah, look, that would segue with our experience on the ground. To give you an idea, last week in Ashfield, we put an apartment on the market, and we told the owner 6 to 660, based on sales. Went for 738. 26 first home buyers and their parents turned up for the first inspection, and the property drew 6 offers in 6 days, and 3 parties went over $700,000 on a unit that the research told us had a maximum value of $660,000.
There you go. It's anecdotal evidence, but it's showing up in our numbers as well. We're just not seeing the rate of decline in units that we're seeing in standing houses.
And coming to our bullet point here about the rental market rose 7.5% in the first 6 months of 2026. Like, we're talking annualised growth there of potentially 15%.
Peter, I think that's actually our 12-month change.
Okay, it's 12 months.
Yeah, it's 12 months. Yeah, it's an annual change.
So for the last 12 months, we're talking 7.5% growth in the rental market in Sydney.
Yes.
Yeah. Is that causing people that are renting with the help of their parents to go out and buy their first property, which is why it's fueling the market?
Yes, we would be seeing more renters turn themselves into first home buyers, and that has been occurring. The 5% deposit scheme that was essentially uncapped back in October 2025 did see an increase in renters turning themselves into first home buyers, but clearly not enough because rents have still been rising. I've got a lot to say about the 5% deposit scheme because I think the truth of the matter is that a number of those first home buyers who bought in using that scheme are now underwater given the housing price falls, which is not a good position to be in.
It brings me to one of my next questions. We find ourselves selling properties in different parts of the city.
Yes.
And my anecdotal read from what I'm seeing is that Western Sydney has taken a serious whack. For a long time, you were quite right in saying the outer ring was going to outperform the inner ring, and that was without doubt what happened. But are you seeing some serious carnage happening in certain suburbs in Western Sydney and southwestern Sydney?
And being upfront, Peter, it's fair to say that the declines that I'm seeing through the data have been across Sydney.
Yes.
I hear you that there is weakness in Western Sydney, but I'm also recording some severe weakness in, for example, the Northern Beaches.
Yes.
I'm recording severe weakness in Sydney's eastern suburbs for pockets of affluent property. And when I consider this downturn in Sydney, I think we're seeing an economic slowdown as well in Sydney, and the financial services sector, which the city has the largest proportion exposure to compared to any other capital city, is bleeding. So we are seeing job losses in the financial services sector, and I'm actually relatively close, so I can see it firsthand. And that historically has had an impact upon the Sydney market. That's not to say that we're not recording weakness in the western suburbs, and quite clearly you're seeing it on the ground, which is very useful. I guess my argument is we're seeing it across the board in Sydney, in our view.
What I would say in the inner west and certainly eastern suburbs and northern beaches, from the research that I've done and the sales that we've been involved in, that $5 to $15 million bracket that was so strong coming out of COVID
has been slammed.
That has been slammed in the last 3 to 4 months.
Absolutely. I've got anecdotal evidence looking at individual properties that had like a $8 million price tag on them, dropping to the sevens quite clearly. Hundreds of thousands of dollars been taken off to try and move them.
When you take into account stamp duty, selling costs and the downward pressure on market, I think we're very close, unfortunately, to seeing people have $1 million losses on real estate, aren't we?
This is true. Now, in all this, we're going through a bit of a shock and awe, and sooner or later the market will return to some type of equilibrium where the market will trade on a higher rental yield. The thing is with affluent real estate, when you think it through, we know that you still CGT free on your principal place of residence. So therefore, there is a probability here that affluent people will buy even more expensive real estate as their principal place of residence as a tax shelter. So I think in time, once the economy does settle and stabilise and there's a little bit less fear in the economy and in the markets, we will see Sydney's affluent property market do okay.
And how far away time-wise are we from that, Louis?
2027 perhaps.
Yeah.
This adjustment, let's keep in mind that this is not the first time Labor have put forward property taxation changes. They flagged it way back in 2016 for the 2016 election, if you recall.
But we've never been as close to it being a reality as what we are now.
That's exactly right.
Yeah.
The point being is we did some modelling back then and also in 2019 on their policies, and our modelling showed that this adjustment period would last between 2 to 3 years, keeping everything else equal. Now, I don't think everything will be equal over the next 2 to 3 years. I actually think we might see some interest rate cuts in time. But nevertheless, keeping everything equal, the adjustment period is likely to last at least 2 years. And then the whole market will trade on a higher rental yield. And when it does, finally we'll see investors come back into the market again.
Louis, let's go to the auction clearance rates at the moment on your numbers and bring up our next slide. Just talk us through what has happened with the auction clearance rates, because rarely have we seen them operating at the levels that they're stuck at the moment. Yeah,
so clearance rates are basically back to where we were briefly during the 2020 first lockdown. So if you strip out those few weeks of panic that we had during the first COVID lockdown, we're recording the lowest and consistently the lowest clearance rates since our series began.
The thing that is disconcerting from my perspective is we have auction clearance rates that are stuck between 30 and 40% for the last 3 months.
Yeah.
But we're in winter when stock levels are low.
Yeah, so what tends to happen seasonally is that you see a little bit of a rise in the clearance rate over winter, but we're not getting that. And then the real concern is, yes, seasonally you see tighter listings, and we are seeing less listings now, but they're still at the same levels that we recorded this time last year, Peter. So I don't think sellers are actually leaving the market. We will, in about 60 days' time, go back into the spring selling season. And that's when we will see a seasonal rise in listings. And normally what you see during the spring selling season is a fall in clearance rates. So if nothing changes in terms of where interest rates are sitting, or assuming the government sticks to their knitting, they don't want to change course on property taxation changes, the odds are pretty high that we'll see even lower auction clearance rates during the months of August, September, October, November and December.
So you're talking about falling into the 20s, if not the teens there?
It's possible.
It's possible.
The 20s, yeah. I think the 20s are a real likelihood, keeping everything else equal right now.
For my 26 years in real estate sales, Louis, I've constantly cautioned people against having the spring selling mentality. And I've often said to clients that you should aim to sell in winter and buy in spring. And what you're saying, what you've just said there, is your numbers back that up.
Absolutely, they always have.
Yeah. Louis, a little bit of an interesting side issue with your auction clearance numbers, which people have pretended for a long time don't exist, because you use a different methodology, which I've explained numerous times on Talking Property, so we won't again. But you use a different methodology to the rest of the marketplace.
That's right.
But suddenly the mainstream media, if we bring up this post that you did here on social media, became very, very interested in your auction numbers.
And they still are.
Yeah.
Look, the media, of course, are interested in grabbing headlines.
Yes.
And yes, our clearance rates are painting a picture of a very weak market where, in Sydney, essentially 2/3 of properties scheduled for auction are being passed in, withdrawn, rescheduled, and that is the reality. But yeah, the media is definitely more interested in that because it is painting a rather negative story on the market, which
because it's
fundamentally
aligning with
is
their
true.
narrative. It's aligning
with their narrative, and
Yeah.
look, in a more bullish market, they'll probably go with other providers in terms of higher clearance rates,
Yes.
and that's what we tend to see. And it is what it is. Peter, I've had a long history with disputing auction clearance rate methodologies and
Yes.
what's been reported. I'm an older man now, so I'm starting to settle down on that, and I'm just happy we've got our own clearance rates out there, and we've got a very strong supportive following, I note, by many, many real estate agents.
Yes.
And this is a point I think a number of the data providers do not seem to respect, is that agents are using these reported clearance rates as a benchmark to what's happening in-house, what's happening on their own turf. And if you're having an overly juiced up clearance rate as a benchmark, many of these agents don't look that very good. Whereas actually they're performing okay. They're performing in line with what's going on with the market. No, we have been having increasing support There'll always be a trade-off though between timing and accuracy though, Peter, I've always found in the housing market. We can't come out on the weekend itself, but we can come out on Tuesday with all the results.
And I do respect that the mainstream media want to report the Saturday auction clearance rates on Saturday.
I don't blame them. That's fine. I mean, if I was an editor, I'd have to do the same.
You'd have to do the same. But what the viewers at home do need to realise is that there's consistently a major discrepancy between the preliminary rate and the final auction clearance rate, and it's always scaled down. It's rarely, if ever, scaled
Well,
up.
I was about to say that. Can anyone name a week where it was scaled up?
Yes, yeah.
It's never happened.
So consistently for the last 3 months, the auction clearance rate has been stuck in the low 30s, and the mainstream media have been calling it as being positioned in around 50%. Now, how that dictates behaviour is that if you're a prospective vendor coming to market and you're listening to the mainstream media saying, well, auction clearance rates are at 50%, they're not the best odds in the world, but they're not the worst, that has a bearing on your thinking one way. But if you are completely attuned that, for example, last weekend the auction clearance rate on your numbers was 32%, that might change the decisions you make as a vendor.
Absolutely.
Yeah.
Absolutely. Look, I for one, believe that there are multiple strategies to bring a property to market, and there is no perfect strategy. And I think it just depends on the market. So there's a time and a place to auction a property, and there is a time and a place where perhaps doing a tender or just standard private treaty is the way to go. That's just my view, and I'm not saying my view is the holy way. So yeah, I'm not anti-auctions. I'm not overly positive for auctions. I'm here to report what's going on in the market.
Yeah, indeed. Well, look, I'm pretty comfortable in saying to our clients, you have to consider whether auction is the right sales strategy at the moment.
Yeah.
The other adjunct to all of this is that of those 32% that are counted as successful auctions, more than half are selling prior to. So if your vision of an auction is multiple emotional bidders in the backyard competing for your home, that is just not the reality out there on the ground.
Not right now, no.
No. The Treasurer, moving along, Louis, the Treasurer is under pressure as to what he's induced first home buyers into with the 5% deposit scheme. We're 8 months into that scheme having been introduced. What's your takeouts?
Yeah, so the actual scheme itself has actually been with us since 2020. There was a major expansion of the scheme in October 2025 where essentially it was no longer means tested and the housing price cap was clearly lifted. We understand that from October through to March 2026, nationwide, there were about 120,000 people taking advantage of the scheme and applying for it and receiving the scheme. And in Sydney and Melbourne, that translated to about 50,000 first home buyers getting into the housing market between October and March 2026. Now, on the face of it, that sounds like the scheme's been reasonably successful. However, going back to my earlier point, the housing market's been falling at least since February. And so, sadly, a number of these people, particularly in Sydney and Melbourne, are now in a situation where they're in negative equity. In other words, where the value of the home is worth less than the debt that is owed on it.
Underwater, as they say.
Underwater. That is exactly right. The problem is in this country, you can't just hand the keys back. If you decide to sell your property and you still got debt outstanding on that home, you have to pay the bank, otherwise they're going to personally make you bankrupt.
Look, this is a vexed issue for mine. I've seen both sides of the ledger where, as I said, I've seen evidence like auto valuations, take them with a pinch of salt in some ways, but realestate.com for some properties that I've been following in Western Sydney have shown since February one property's auto val has dropped from 135 to 115, $200,000 drop in Glenwood, for example. And then I have my experience in Ashfield with the one bedroom unit, which is not isolated. We've had that happen a couple of times where a crowd turns up out of nowhere and drives the property above expectations. So yes, if you jumped into purchasing a property in parts of Western Sydney in late 2025, you're absolutely underwater, and some at the moment. And then there's other segments of the market, like the affordable unit market, which seem to be supercharged on it. So I think the message out of all of that, people need to be very, very careful on the ground.
Look, I have never bought a property, like when we bought our first home, we bought it on a 15% deposit, and that gave us a buffer. And I'm glad we had that buffer.
Yes.
That's important. To buy on, just say, a 5% deposit, or even for single families doing on a 2% deposit, well, that's really tight.
Well, it's completely reckless.
Well, it's dangerous,
Yeah.
and I do feel for those first home buyers who've done that in recent months. Now, the good news is that the market will eventually stabilise, and the good news is that provided you can keep servicing the mortgage and paying it down as quickly as possible, you will get yourself back into positive territory sooner or later. But there are risks. We have not seen the bottom of this downturn yet, and I don't think we'll see it at the earliest until 2027. The degree of negative equity that some or a number of people are going to face is going to be quite significant. And people need to recall the issue with this is that you won't be able to borrow money elsewhere. You go for a loan and you write on your balance sheet you're in negative equity. Okay, no lender's going to give you money.
So there's knock-on effects.
There are knock-on effects,
Yeah.
which are not really discussed out there, but it's the truth.
Great point, great point. So if you've got aspirations of buying a property and then starting a business.
Starting a business, buying a car, taking a holiday, if you want to do it, not that I recommend borrowing money to take a holiday, but you get my point. You
Yes.
cannot borrow elsewhere if you're in negative equity on your home.
The tentacles spread if you're in negative equity.
Absolutely, they
Right
do.
through your life, yeah. Louis, I think it's really important, and I always caution buyers in every downturn that every downturn ends, and I caution sellers in every boom that every boom ends. And you need to know that we're running cycles. This is, in fairness, quite an unusual cycle given what's driving it. But this downturn, whilst it has further to run, it will end.
It will end. Now, what we've been saying is that because of the property taxation changes, investors will want to be compensated by a high gross rental yield. Sydney trades on a gross rental yield now, on average, roughly just under 4%.
Yeah, well, let's bring up our next slide, because that was related to the rental market, Louis. So thanks for introducing that topic. What are we seeing in the rental market? Because coming into this year, I was particularly bullish about what would happen with rental prices. Bullish meaning I believe they were going to rise far stronger than anyone anticipated.
Yeah.
Not to say that I was happy about that, but what has happened with the rental market?
So advertised rents have been accelerating once again since about the start of the December quarter 2025. To your point earlier, we're now recording, for example, in Sydney, rent rises for the past 12 months of about 7.5%, which is very, very strong for Australia's largest capital city. With the property taxation changes, the probabilities have increased that we'll see a further acceleration in rents, simply by virtue of the fact we'll have less investment properties in the marketplace.
A shrinking rental pool?
Yes. Now, I've heard a counter-argument, which I think is interesting to sort of mull over, and that is we might be seeing demand destruction, that there is a limit in terms of what the market's willing to bear in terms of rents, and that the community will adjust accordingly by, for example, lower housing formation, people sharing together more to share the burden of the rent. And if we were to go into an economic slowdown, a material economic slowdown, I struggle to see how rents would really accelerate from here.
Right, well, you've led into one of the next points that I wanted to raise. Once you see the level of growing homelessness in our society, you can't unsee it. I don't know if you know that.
I've seen it all. I've seen it expand and expand all through my life.
Yeah.
It's been particularly noticeable in the Sydney CBD.
There's communities forming around beaches.
Yeah.
Tent communities, van communities, car communities, and it's not just in Sydney beaches either, I might add, up and down the coast.
Yeah.
Is homelessness
That's
the
right.
next phase of the rental crisis?
It's a logical outcome that's what you see. When the population is expanding faster than our build rate, what happens? People share more, but those people who are unfortunately not in that position become homeless. So yes, homeless rates have been rising, and no great surprise. And it's sad. It's a sad outcome of an economy that could be better managed.
Oh, indeed. Now, look, when you mention homelessness to people that have not tuned in to the issue, and I'm trying to not wanting to sound conceited here, but when you mention the issue of homelessness, they do jump to the person sleeping on a piece of cardboard, with their begging bowl out in Pitt Street Mall. Mm-hmm. That's the vision that comes up with homelessness. But it is far more nuanced than that, where you've got people living in tents, vans, car communities. They're showering in council facilities at beaches and parks, etc. And this is how they're getting by.
But it's not just that, Peter. Let's think about, for example, women who are in an abusive relationship.
Yes.
And of course they need to leave that relationship. But what are their options? I'm sure a proportion of these women, they're thinking very closely about this, saying, okay, do I stay another week with my abusive partner, or do I live out on the street? I mean, what an awful, horrendous decision to make. But sadly, because of our housing shortage, these type of events have been playing out.
The other one that's a little bit more nuanced that I'm seeing as a real estate agent, I constantly go into people's homes to do market appraisals, and they've got a working adult child that's moved back home. And when I say working adult child, I'm not talking about an 18-year-old that had to go and came back because they wanted their clothes washed. I'm talking about a professional adult child in their 20s or 30s, but the cost of living, the cost of rents, the cost of getting ahead has driven them back to mum and dad. Now, technically they've got a roof over their head. They're in a fortunate position where their parents can have them back home. But if you've gone out into the big wide world, you've got yourself a degree, you've got yourself an apprenticeship, you've rented a property, and rents, because of the immigration policy and the shortage of dwellings, have forced you back home. My way of thinking is that person is technically homeless. They're living back with mum and dad. Yes, they have a roof. They're not sleeping down at the local beach in a van or a car, but they've gone out and tried to make a go of it in good faith and haven't been able to pull it off.
Yeah, and so now they're going to have to live with the fact that they will feel it like as though they've failed in life.
And then there's further knock-on effects from that again.
Exactly.
So you can see here that Pauline Hanson, we won't touch the One Nation issue today, but she is talking to the homelessness. So the politicians, and if you're following the ads, if you do listen and watch ads, you see that the homelessness issue is growing.
It is
as a social construct, isn't it?
Yeah, that's exactly right. And yes, there is a logical path that a very strong migration flows into the country, not matched by supply increases, will increase homelessness. That is the reality of it. So I've always looked at this argument as a demand and a supply issue. I find it disingenuous, certain organisations who just try to argue it on the supply side without even considering the demand side. That's just crazy talk. But we need to do better on both. And I believe there's always been a time and a place to ramp up migration and a time and a place to slow down migration, more so than what we've been doing now.
So given that we're clearly not building enough dwellings, and it's clearly playing out in the rental market and the first home buyer market for affordable properties, what do you make when you see the government's take a bow for only letting 300,000 people into the country, and they say they're listening to the people because we've dialed it back from 450,000?
It's still above what we had from, say, 2015 to 2019. Right, so when the numbers were running in the 200s.
But were we building more dwellings then?
We were building about the same amount as what we were now.
Right.
But migration rates were lower. The country was expanding by less than what we are now. And rental vacancy rates were clearly higher than what we have now, and rents were more stable, more in line with the CPI.
So, Louis, wealth inequality in Australia has never been wider in our lifetimes. Is the policies that the government are implementing and pushing through the parliament, are they going to rebalance things or make it worse?
What's been put forward, in my view, has the propensity to increase rents. I think there's been a complete lack of care or unbelief that investors are required in the housing market. They're required because they help, for example, on new builds. But investors will not be in the market when the market is having a major downturn. This is just one of these beliefs I think that the Labor government's just got wrong. Their view that we're going to see now an increase in housing construction. We're not going to see it because that takes investors, and investors are not going to jump in the market while it's falling. Who wants to catch a falling knife?
Yes.
Historically, investors have never jumped into the market when it's falling. They are momentum driven. They'll go into the market once it bottoms and starts rising, but they will not jump in en masse while it's falling at a rate of knots.
So just adding a little bit of meat to the bone there is that the government have removed negative gearing off existing properties, but you can still negative gear a brand new property.
You still can.
Yeah.
My argument though is you're not going to see investors take advantage of that anytime soon en masse, because no one wants to jump in while the market is falling. And let's also consider that new property generally trades at a premium to the rest of the market. That premium narrows and narrows like a car coming off a showroom floor on new property.
Indeed it does.
And so the risk of having negative equity once again for an investor is actually quite high when they're buying new property.
The best time to purchase a brand new build is the resales, as everyone gets their settlement letter and they've bought off the plan in the previous 2 to 3 years and settlements upon them, and it's like, my life has changed, my financial position is different, I now need to sell this. The only problem is, particularly with bigger developments, there's other people in the same boat. And you see a number of properties in newly completed developments coming up for resale, and they're competing against each other. And as you said, the brand new property syndrome, the value drops immediately.
You know, in recent years, we've had some rather poor examples of of builds going very badly indeed for the new purchases. Now, I think standards have improved a little. The state government here in New South Wales has made a genuine attempt to make sure we don't have these type of issues again. But I think there's been a stigma attached to new
That's
property.
right. I was going to say standards have improved, but confidence hasn't.
Confidence has not as yet.
Yeah. Louis, yesterday the Greens and the Labor Party did a deal, and we'll finish on this point, to ban self-managed super funds from borrowing money to purchase property. That's just another element of demand that has been taken away from the property market. Before today in the media, everything else about the budget has been discussed deeply, so we won't drag people through that again. But this issue about banning self-managed super funds from borrowing to buy a property, what's your take on that?
It will once again mean less investment properties in the market. Now, I don't think the proportion of properties held, residential properties held by a self-managed super fund is that high compared to total ownership in this country. The reason is that you were not getting the negative gearing benefits holding a property in a self-managed super fund to begin with. And so
they're more likely to be commercial investors?
They're more likely to be commercial.
Yeah.
So I think the actual impact on the ground is not going to be huge over and above what's already happened. Of course, I have my own political views, and I am a believer that self-managed super fund people should do what they want with their super, except obviously spend it on consumption. But in terms of investing, it's fundamentally their money, and they should be allowed to do it. That said, I've also taken the view to you've got to be careful about putting all your eggs in one basket. And I think the government's viewpoint on this is that we should still see diversification in terms of investment holdings. And if people put everything into their home and no additional investments, well, that could be risky.
Well, the policy that they've agreed on with the Greens yesterday essentially pushes most people's super back towards industry super funds.
It can, yes. Look, it's certainly taking it away from residential property,
Yeah.
but there are
And
other
commercial.
There are private superannuation funds out there by some very large names, AMP, Macquarie, BT, which are not industry or union-driven superannuation funds, which invest in equities, fixed income, you name it. I am concerned that was a real motive behind all this. The reality is, though, for those out there, that there are more options than just industry super funds, even with this policy change.
But industry super funds will be a very big winner out of this policy.
It will be. There's no question about that.
Louis, excellent wrap on what was a very dramatic opening to 2026. Thanks for your time today.
Good to be here once again, Peter.
And thank you for joining us today on Talking Property. We look forward to speaking with you next time.